Welcome back to the channel. Today, we're conducting a comprehensive financial analysis of UnitedHealth Group's latest results and their strategic outlook for the coming year. This is a deep dive into the numbers that drive one of the world's largest healthcare organizations. Before we dive into the data, please take a moment to like this video and subscribe to the channel so you never miss our in-depth market insights. Let's get started. We begin our analysis with the high-level overview of UnitedHealth Group's 2025 performance. The company reported a massive full-year revenue of $447.6 billion, reflecting its immense scale across both the UnitedHealthcare and Optum segments. This performance resulted in an adjusted earnings per share of $16.35, though GAAP EPS stood at $13.23. These figures set the stage for our detailed look at how the organization navigated a complex year characterized by significant growth but also notable operational challenges. As we transition into the 2026 outlook, it's clear that the company is focusing on right-sizing its operations and aligning its pricing strategies with the evolving medical cost landscape. This report, released in late January 2026, serves as a critical blueprint for investors and analysts tracking the healthcare sector's stability. Throughout this video, we will break down the components of these results, from segment-specific performance to the broader cost trends and medical care ratios that influence the final bottom line. Understanding these numbers is essential for grasping the strategic direction the company is taking as it enters a new fiscal cycle focused on transparency and technology-driven efficiency. Moving to the 2025 financial snapshot, the data reveals a year of robust top-line growth. Total revenue reached $447.6 billion, representing a solid 12% increase year over year. This growth is impressive given the scale of the enterprise. However, when we look deeper into the profitability metrics, the picture becomes more nuanced. Earnings from operations were reported at $19 billion, while cash flow from operations remained strong at $19.7 billion. One of the most striking figures on this slide is the net margin, which came in at 2.7%. This reflects the intense pressure from elevated medical cost trends and the various one-time charges the company faced during the year. The adjusted earnings per share of $16.35 for the full year remains a key benchmark for performance. But it's the adjusted medical care ratio of 88.9% that tells the real story of the operating environment. This ratio, which measures medical costs as a percentage of premiums, is a critical indicator of profitability in the health insurance business. The increase in this ratio highlights the challenges in managing medical expenses amidst shifting demographics and policy changes. Despite these headwinds, the strong cash flow positions the company to continue its strategic investments. The revenue growth trajectory from 2024 to 2025 underscores UnitedHealth Group's dominant market position. Revenue increased from $400 billion in 2024 to $448 billion in 2025, a $47.3 billion absolute increase. This 12% year-over-year growth was driven by significant expansion in consumer engagement across its core brands. Specifically, UnitedHealthcare now serves 49.8 million consumers, while Optum has expanded its reach to serve over 123 million consumers. This massive consumer base provides the foundation for the company's integrated care model. The growth is not just about scale, it's about the depth of the relationship with these consumers. The increase in Optum's consumer count is particularly noteworthy as it reflects the continued shift toward value-based care and the integration of pharmacy, clinical, and data services. By expanding its reach, UnitedHealth Group is better positioned to manage the total cost of care for its populations. However, this growth also brings increased complexity in operational management and requires constant adaptation to local market conditions and regulatory requirements. The 12% growth rate is a testament to the company's ability to execute on its core strategies even in a volatile environment. But as we will see, maintaining margins during this expansion has been the primary challenge. While revenue grew, Earnings from operations faced significant headwinds in 2025, dropping from $32 billion in 2024 to $19 billion. This slide provides a crucial breakdown of the one-time charges that impacted the bottom line in the fourth quarter. The most significant impact came from restructuring and other charges, totaling over $2.5 billion. Additionally, the final costs associated with the high-profile cyberattack amounted to $799 million, highlighting the ongoing risks in digital healthcare infrastructure. There were also net portfolio divestitures that added $442 million back, but the total net earnings impact remained a substantial negative $1.6 billion for the quarter. These challenges reflect a period of transition for the company as it cleans up its balance sheet and prepares for a more streamlined future. The drop in operating earnings is a stark reminder of how external shocks and internal restructuring can impact even the most stable companies. Investors should pay close attention to how these charges are classified, whether they are truly one-time events or if they signal deeper structural issues. The company's management has emphasized that these steps were necessary to finish 2025 as a much stronger company, but the impact on the year's overall financial health was undeniable. Analyzing the UnitedHealthcare segment performance, we see a divergence in growth across different business lines. The total revenue for UnitedHealthcare grew 16% to $344.9 billion. The standout performer was the Medicare and Retirement segment, which saw a massive 23% revenue growth, reaching $171.3 billion. This highlights the ongoing demographic shift and the company's successful capture of the senior market. Community and state also showed strong growth at 17%. In contrast, the employer and individual segment saw a much more modest 1% growth, reflecting a mature and highly competitive market. Crucially, the operating margin for the entire UnitedHealthcare segment fell from 5.2% in 2024 to 2.7% in 2025. This significant decline was attributed to Medicare funding reductions and elevated medical cost trends. This margin compression is a key concern for the 2026 outlook and explains the company's shift toward stricter pricing discipline. The ability to manage these costs while continuing to grow the Medicare Advantage and Medicaid populations will be the defining challenge for the UnitedHealthcare leadership team. The 16% total growth is impressive, but the sustainability of that growth depends on restoring margin health through better cost management and strategic pricing. The Optum segment also presented a mixed performance in 2025, with total revenue reaching $270.6 billion, up 7%. Optum Rx was the primary driver of growth with a 16% increase in revenue to $154.7 billion and adjusted earnings of $6.1 billion. Optum Insight saw a 4% revenue increase and maintained healthy adjusted earnings of $3.7 billion. However, Optum Health faced challenges, reporting a 3% decline in revenue to $102 billion and a GAAP operating loss of $278 million. Despite this, its adjusted operating earnings were $2.3 billion, reflecting the impact of one-time items on the GAAP figures. The overall Optum adjusted earnings stood at $12.1 billion. This segment's performance is critical because it represents the diversified services arm of the company. The decline in Optum Health revenue and the pressure on earnings highlight the difficulties in the integrated care delivery space, where labor costs and medical utilization have remained high. The new leadership at Optum is now focused on rebaselining the business to better integrate value-based care models. This strategic pivot is intended to drive better synergy between Optum's pharmacy and clinical services, ultimately lowering the total cost of care for the populations they serve. The medical care ratio, or MCR, is perhaps the most scrutinized metric in this report. The adjusted MCR increased by 340 basis points from 86% in 2024 to 89% in 2025. This significant jump was driven by several key factors, including Medicare funding reductions, often referred to as CMS cuts, and the impacts of the Inflation Reduction Act's Part D changes. These regulatory shifts have made it more expensive to provide care and manage pharmacy benefits. On a positive note, the company did see $140 million in favorable medical reserve development. Looking ahead to 2026, the company is guiding for a 10 basis point improvement in the MCR, targeting 88.8%. Achieving this will require a combination of pricing discipline and more efficient medical management. The inflation in medical costs, driven by higher utilization and rising provider prices, remains a persistent headwind. The company's ability to accurately forecast and price for these trends is essential for margin recovery. This slide also highlights the sensitivity of the business to policy changes, where even small shifts in government funding can have a multi-billion-dollar impact on the bottom line. Investors will be watching the quarterly MCR prints in 2026 very closely to see if the company's pricing actions are successfully offsetting these systemic cost pressures. Turning to the 2026 full year guidance, the company is projecting a period of consolidation and margin improvement. Revenue is targeted at over $439 billion, which actually represents a 2% planned decrease year over year. This planned right-sizing reflects the company's exit from certain underperforming markets and a focus on more profitable business lines. Despite the lower revenue, operating earnings are expected to grow significantly to over $24 billion, with the operating margin recovering to approximately 5.5%. Adjusted EPS is guided to be over $17.75, a healthy increase from 2025 levels. Cash flow from operations is also projected to remain strong at over $18 billion. Other key targets include a medical care ratio of 88.8%, plus or minus 50 basis points, and an operating cost ratio of 12.8%. These targets suggest that management is prioritizing profitability over sheer scale in the coming year. The focus is clearly on operational efficiency and restoring the core margins that investors have come to expect. If UnitedHealth Group can hit these numbers, it will signal a successful turnaround from the challenges of 2025. The success of this guidance depends heavily on the company's ability to execute its pricing strategies and manage the transition out of less profitable contracts without losing significant market share. The membership outlook for 2026 further illustrates the company's focus on profitability over volume. UnitedHealthcare expects a net contraction in medical members of between 2.3 and 2.8 million. This is driven primarily by declines in commercial risk, Medicare Advantage, and Medicaid populations as the company exits less profitable regions and tightens its underwriting standards. Specifically, Medicaid is expected to decrease by 640,000 members, while Medicare Advantage could see a drop of 1.175 million. Conversely, the commercial fee segment is expected to grow by 550 to 750,000 members. Despite the overall membership decline, the revenue target for UnitedHealthcare remains over $335 billion, with an operating earnings target exceeding $10.8 billion. This implies an operating margin of approximately 3.2%. This value over volume strategy is a direct response to the margin pressures seen in 2025. By shedding higher risk or lower margin members, the company aims to stabilize its financial performance and focus its resources on segments where it can drive the most value. This membership right-sizing is a bold move that acknowledges the current limitations of the Medicare and Medicaid funding environments, prioritizing a leaner, more profitable membership base that can be managed more effectively within the existing cost structures. Finally, let's look at the strategic priorities that will define UnitedHealth Group in 2026. The company has identified 5 key areas of focus. First is pricing discipline, aligning pricing to account for higher medical trends and policy changes. Second is the Optum rebaseline, with new leadership focused on integrated value-based care. Third is transparency through independent business practice reviews that are currently underway. Fourth is a commitment to technology and AI to improve care access, navigation, and affordability. And fifth is debt reduction, with a target of a 40% debt-to-capital ratio in 2026. CEO Stephen Hemsley noted that the company confronted its challenges directly and finished 2025 as a much stronger organization. These priorities signal a return to fundamentals. The emphasis on AI and technology is particularly interesting as the company seeks to use data to drive better clinical outcomes and lower administrative costs. Meanwhile, the focus on transparency and debt reduction aims to reassure investors and regulators of the company's long-term stability. By executing on these priorities, UnitedHealth Group aims to move past the volatility of 2025 and establish a more sustainable and efficient path forward. The integration of these strategies across both UnitedHealthcare and Optum will be the key to maintaining their leadership in the healthcare sector. It's a clear roadmap for a year of recovery and strategic refinement. Thank you for joining us for this in-depth analysis of UnitedHealth Group's 2025 results and 2026 outlook. It's clear that while the company faced significant headwinds, its strategic pivot toward profitability and pricing discipline marks a new chapter in its growth story. If you found this analysis helpful, please give this video a thumbs up and share your thoughts in the comments below. What do you think of their value over volume strategy for 2026? Don't forget to subscribe for more deep dives into the financial markets. We'll see you in the next analysis.